The petrodollar just ended. You heard that right. Except what most people screaming that headline mean by ended and what the forensic record actually shows are two completely different things. And the difference between those two versions of this story is the difference between panic and preparation. Between reacting to a headline and understanding a mechanism that has been running for 50 years is genuinely fracturing right now, and has already begun the process that historically destroys one category of asset and creates generational wealth in another. So let's do this properly. Let's do the autopsy. May 2023. Saudi Arabia's finance minister Mohammed Al-Jadaan stands at the World Economic Forum in Davos and says something that would have been unthinkable from a Saudi official in any previous decade. He says Saudi Arabia is open to trading in currencies other than the US dollar, not threatening it, not demanding it, open to it. The careful language of a man who understands exactly what he is saying and exactly how far he can say it. 6 months later, Saudi Aramco completes its first oil transaction with China settled in yuan. Not a symbolic gesture, a real commercial transaction. Priced in yuan, settled in yuan, no dollars involved. In 2024, the BRICS nations, Brazil, Russia, India, China, South Africa, expanded their membership to include Saudi Arabia, the UAE, Iran, and Ethiopia, among others. The original BRICS represented roughly 26% of global GDP. The expanded bloc represents closer to 37%. Every single one of the new members is either a major energy producer, a major energy consumer, or both. And the explicit agenda of every BRICS summit for the past 3 years has been the same: reduce dependence on dollar-denominated settlement in international trade. The question is no longer whether this is happening. The question is what it means, how fast it moves, and what the historical record of previous reserve currency transitions tells us about who gets destroyed and who comes through intact. Here is what the petrodollar actually is, because the term gets used constantly and understood rarely. In 1971, Richard Nixon closed the gold window. The Bretton Woods Agreement had pegged the dollar to gold at $35 an ounce and every other major currency to the dollar. When Nixon ended dollar-gold convertibility, the dollar lost its structural anchor overnight. What replaced it 3 years later was a deal so consequential, so quietly constructed, and so poorly understood by the general public that its architect Henry Kissinger did not discuss it publicly in full detail until decades afterward. In 1974, the United States reached a series of agreements with Saudi Arabia, the core of which was elegant in its simplicity. Saudi Arabia would price its oil exports exclusively in US dollars. Saudi Arabia would invest its surplus oil revenues in US Treasury securities. In exchange, the United States would provide Saudi Arabia with military protection and security guarantees. Every other OPEC nation followed. The dollar had found its new anchor. Not gold, oil, the thing the entire industrialized world needed to function. Any country that wanted to buy oil needed dollars first. Any country that needed dollars had to either earn them through exports or borrow them. The demand for dollars was structurally guaranteed by the demand for energy. That is the petrodollar system. That is what is now, for the first time in 50 years, genuinely under pressure. But here's the critical distinction that every breathless headline about the petrodollar's death gets wrong. The system has not ended. What has begun is something more specific, more historically significant, and frankly more dangerous to ordinary dollar-denominated savers than an abrupt ending would be. What has begun is a transition. And transitions in reserve currency systems are not events. They are decades. They are the most financially violent decades in the history of the countries holding the outgoing currency. And the forensic record of every previous reserve currency transition in modern history shows with brutal consistency exactly which assets are destroyed, exactly which assets survive, and exactly how much warning the people who came through had, before the people who didn't even realize anything was changing. Let's go to the last time this happened, not as ancient history, as a forensic case study with direct application to what is developing right now. The British pound sterling is the world's reserve currency. The British Empire controls roughly a quarter of the Earth's land surface. The Bank of England is the institution against which all other central banks measure themselves. British government bonds, consols, are considered the risk-free asset against which all other assets are benchmarked. Sound familiar? By 1944, the dollar had replaced sterling as the world's reserve currency at Bretton Woods. The transition took 30 years. It was not a single event. It was a grinding, decade-by-decade erosion, driven by 2 world wars that exhausted British finances, American industrial dominance that created structural trade surpluses that needed dollar settlement, and a series of currency crises in which sterling repeatedly failed to hold its pegged value against gold. Here's what that transition did to the people holding sterling-denominated assets through it. British government bonds, the risk-free asset, lost approximately 70% of their real purchasing power between 1914 and 1951 as inflation eroded the fixed payments. British investors who held consols, who did exactly what the conventional wisdom of their era told them to do, with the safest possible instrument, were financially destroyed in slow motion over 3 decades, while the nominal value of their holdings barely moved. Cash savings in sterling suffered the same erosion. The people who held productive assets, British farmland, equity in companies with genuine export revenues, gold, and after 1944, dollar-denominated assets came through with their purchasing power substantially intact. The transition from sterling to dollar did not announce itself. It did not arrive with a press conference. It arrived through a sequence of individually explicable events, each of which seemed temporary and manageable in isolation, that in aggregate represented the permanent downgrading of the pound's global role. The people who understood what that sequence meant and repositioned accordingly over the years in which repositioning was still possible came through. The people who waited for official confirmation that the transition had occurred waited too long. By the time the transition was confirmed, the assets that preserved wealth through it had already repriced to reflect the new reality. Now apply that template to what the forensic data is showing right now. Total global central bank reserves held in US dollars have fallen from approximately 73% in 2001 to approximately 58% in 2024. That is a 15 percentage point decline over 23 years. Slow, steady, and continuous. Not a collapse, a erosion. The same pattern that characterized sterling's decline from 1914 onward. China's cross-border yuan settlement through the CIPS system, the Chinese alternative to SWIFT, processed approximately 96 trillion yuan in 2023, up from essentially zero a decade ago. Russia conducts over 90% of its trade with China in non-dollar currencies following sanctions. The UAE has completed multiple LNG transactions with China in yuan. Brazil and China have established direct real currency settlement arrangements, bypassing dollar intermediation entirely. India is negotiating rupee settlement arrangements with multiple trading partners. None of these individually ends the dollar system. Together, over time, they represent the same structural erosion that preceded every previous reserve currency transition in recorded history. The question is not whether the dollar loses reserve currency dominance. The historical pattern says it eventually will, as every previous reserve currency eventually did. The question is the same one that faced sterling holders in 1930, 1940, and 1950. How much time is there? What are the signals that the transition is accelerating? And what did people hold during previous transitions that preserved their purchasing power through it? The signal framework matters here because this is where the forensic record becomes directly actionable rather than merely historical. There are 5 specific signals that appeared in the data before each of the major sterling crises of the transition period, that appeared before the dollar crises of the 1970s when the petrodollar system was being constructed to solve them, and that are appearing again in the current data in forms that are visible if you know what to look for. The first signal is central bank gold accumulation. When central banks begin systematically buying gold, they are expressing a view about the future purchasing power of the reserve currency they are diversifying away from. They are not doing this publicly or loudly. They are doing it in quarterly reserve reports that most financial journalists never read. In 2022 and 2023, global central banks purchased gold at the highest rate since 1967, the year before the sterling devaluation that effectively ended the pound's reserve currency role. China's official gold reserves have increased every month for which data is available since late 2022. Russia tripled its gold reserves between 2014 and 2022. Turkey, India, Poland, and Singapore have all made significant additions. Central banks do not buy gold for aesthetic reasons. They buy it when they are repositioning away from a currency they expect to lose purchasing power. The people who read that signal in 1965, when de Gaulle was shipping dollars back to the United States and demanding gold in exchange, understood something that took the general public another 6 years to see. The second signal is commodity pricing in alternative currencies. The yuan oil trade is the most visible example, but it is not the only one. Russia has been pricing its commodity exports to China in rubles and yuan since 2022. Saudi Arabia's stated openness to yuan pricing is a signal of a different order than actual transactions, because it tells you where the direction is pointed before the movement is measurable. In the sterling transition, the signal was not Britain losing reserve status in a single moment. It was commodity producers beginning to accept dollars for transactions they had previously conducted in sterling. Once that started, it did not reverse. It accelerated. The yuan commodity pricing experiments of the current period are at the same early stage that dollar commodity pricing was in the 1930s and 1940s. They are not the end. They are the beginning of the erosion becoming structurally embedded. The third signal is U.S. fiscal trajectory. The dollar's reserve status has historically been supported by the perception that U.S. government debt is the ultimate safe asset, the instrument of last resort for global capital. That perception depends on the U.S. fiscal position being fundamentally manageable. At a debt-to-GDP ratio above 120%, with annual interest payments on that debt now exceeding $1 trillion and projected to grow faster than GDP, the arithmetic of U.S. fiscal sustainability is becoming increasingly difficult to present as unambiguously sound. This does not mean imminent default. The United States borrows in its own currency and controls its own monetary policy, which changes the default dynamics entirely compared to a country like Greece. What it means is that the premium the dollar commands as a safe haven is being slowly eroded by the same arithmetic that eroded sterling's premium after 2 world wars left Britain with debt-to-GDP ratios that were equally difficult to present as sustainable. The fourth signal is sanctions weaponization. The freezing of approximately $300 billion in Russian central bank reserves following the 2022 Ukraine invasion was the single most consequential event for dollar reserve status since the Nixon shock of 1971. Not because it was wrong or right as a policy decision, because it demonstrated to every central bank in the world that dollar reserves held in Western financial infrastructure are subject to political seizure. Every central bank that is not in complete geopolitical alignment with the United States now holds dollar reserves with the knowledge that those reserves can be frozen by executive order. The rational response to that knowledge is to hold fewer of them. The diversification into gold and yuan that is visible in central bank reserve data since 2022 is at least partly a direct response to that demonstration. Once that knowledge exists, it cannot be unlearned. The diversification incentive is permanent. The fifth signal is the BRICS payment infrastructure development. The CIPS system that China operates as a dollar-free alternative to SWIFT now has over 1,300 participating institutions. A digital yuan settlement system for cross-border transactions is in active development and pilot operation. The mBridge project, a multi-central bank digital currency platform involving China, Hong Kong, Thailand, and the UAE, has completed multiple real value transactions. These are not theoretical. They are operational infrastructure being built in parallel to the dollar system, not to replace it overnight, but to provide an alternative pathway that reduces dependency. In the sterling transition, the equivalent was the development of dollar clearing infrastructure in New York that progressively reduced the necessity of routing international transactions through London. Once that infrastructure existed and became reliable, the shift away from sterling accelerated because the friction of shifting had been reduced. The current development of non-dollar payment infrastructure is reducing the friction of dollar avoidance in exactly the same way. Now here's the part that matters most for anyone holding dollar-denominated assets, not the geopolitical analysis, the historical forensics of what actually preserved wealth through the last reserve currency transition and what was destroyed. Sterling-denominated cash savings lost approximately 70% of their real purchasing power between 1914 and 1951. British government bonds lost comparable real value over the same period. Both of these were the conventional safe assets of their era, the things that sterling-holding savers were told to hold by the financial advisors and institutions of their time, the things that felt safest and most conservative. They were destroyed not by a single event, but by 3 decades of inflation, devaluation, and currency erosion. Each seemed temporary in the moment and was permanent in aggregate. The assets that survived the sterling transition were specific and consistent. Gold maintained real purchasing power through the entire period. British companies with genuine international revenue streams, exporters who earned in multiple currencies, maintained real value because their earnings were not entirely denominated in the declining currency. Real estate in stable jurisdictions held real value. And after 1944, dollar-denominated assets, the currency of the incoming reserve system, appreciated in real terms as their global demand increased. The application to the current transition is direct. This does not mean the dollar collapses next year. The historical timeline of reserve currency transitions is measured in decades, not months. Sterling's decline from dominant reserve currency to a normal currency took from 1914 to the 1970s, when the final sterling area arrangements were wound up. 60 years of gradual erosion. What it means is that the assets most exposed to a gradual multi-decade erosion of dollar purchasing power, long-duration dollar-denominated bonds, dollar cash savings yielding below real inflation, assets whose value depends entirely on dollar stability, are the same structural category as the sterling-denominated bonds and cash savings that were slowly destroyed through the last transition. And the assets that have historically preserved purchasing power through reserve currency transitions are the same ones the central banks are currently accumulating. Gold, productive land with export capacity, equity in companies with genuine multi-currency revenue streams, commodity exposure, the hard assets that retain value regardless of which piece of paper is being used to measure them. Here's the sentence that the entire history of reserve currency transitions reduces to. The currency changes. The wheat does not, the oil does not, the gold does not, the land does not. The company that makes things people need regardless of what currency they are paid in does not. What changes is the unit of measurement. And when the unit of measurement loses credibility, Everything priced exclusively in that unit loses value with it, while everything with value independent of the unit retains it. The petrodollar system is not dead. It is not ending this year or next year. What it is doing is something more consequential for long-term savers than a sudden ending would be. It is eroding, slowly, measurably, with signals visible in central bank reserve data, in commodity pricing experiments, in payment infrastructure development, in fiscal arithmetic, in the behavior of the governments that have most to gain from an alternative. The same erosion that characterized sterling's 50-year decline from global dominance to regional currency. The same erosion that the British savers of 1930, who were still holding consols and sterling cash, had not yet recognized as irreversible. The same erosion that the British savers of 1950 recognized too late to act on without absorbing a generation of purchasing power destruction first. The window between the signals being visible and the transition being complete is historically long enough to act, long enough to reposition, long enough that the people who read the structure, rather than wait for the headline, will have done what they need to do before the people waiting for the headline even know the story has started. The signals are in the data right now. The central banks are reading them. The question is whether you are. Subscribe if you want to keep reading structure before the narrative catches up with it. We perform financial autopsies here so you don't become the next case study.